Hello, everyone, and welcome back to the show. Today, we are tackling a subject that feels increasingly elusive for a lot of people: wealth. Specifically, how the millennial generation can actually build it.
Hi, thanks for having me. It's a huge topic.
It is. And I want to start with a bold claim I saw in the research we're discussing today. There's a premise here that says there is an investment strategy that beats 90% of professional managers. Is simple enough for a 7-year-old to understand, and get this, only takes 15 minutes of work a year.
It sounds like a late night infomercial, doesn't it?
It really does.
But it's actually based on rigorous financial theory. The catch, and there is always a catch, is that while the math is simple, extraordinarily simple, the execution is incredibly hard.
Hard in what way? Like physically hard?
No, psychologically hard. We have to overcome educational barriers, institutional traps, and frankly, our own brains.
Before we get to the how, let's talk about the why. The document we are looking at paints a pretty bleak picture for millennials compared to their parents. Why is the landscape so desolate for this generation?
A lot of people think the problem is Social Security, that it won't be there. But the reality is Social Security will likely survive, maybe with reduced benefits, but it'll exist. The real tragedy is the extinction of the defined benefit pension plan.
Right, the old school pension. You work for 30 years and the company sends you a check every month until you die.
Exactly. Those plans were essentially financial fattening farms. You were forced to save involuntarily. The company handled the investment risk. Now, that safety net is gone. The responsibility for saving and investing rests 100% on the individual's shoulders.
That's a heavy burden if you don't know what you're doing.
It is, and the document puts it bluntly. Unless millennials act with vigor and purpose, their retirement options might range from living with their children to sleeping under a bridge.
Okay, so we don't want to sleep under a bridge. Let's get into the strategy. Where do we start? Investing in the next big tech stock? Crypto?
No, we start way before that. The critical pillar of wealth is an investment, it's savings. You could have the investing brand of Warren Buffett, but if you cannot save money, you will die poor.
That makes sense. You need capital to invest. What's the magic number?
The math suggests that if you start at age 25 and want to retire at 65, the mandatory savings rate is 15% of your gross salary.
15%. That feels high, especially with the cost of living today.
It is high, and that brings us to the first major hurdle: spending. Let's say you earn $50,000. 15% is about $625 a month. In today's world, that margin is razor thin. It can be wiped out by what we call innocuous expenses.
Like the famous avocado toast?
Well, the text mentions things like a daily coffee, an expensive cable package, or an apartment that's just a little too fancy. It's surprisingly easy to bleed $600 a month on things that don't really matter.
It feels like a sacrifice, though, living without those little treats.
It might seem Spartan, but you have to compare that Spartan feeling to the alternative, subsisting on cat food when you're 70 years old.
That's a vivid image.
It's meant to be. There's an inverse correlation here. People with high incomes who spend everything aren't rich. They just have high incomes. To be rich, you have to keep the money.
So let's say I'm ready to save, but I have debt: student loans, a car payment, maybe a credit card balance. Do I invest that 15% or do I pay off the debt?
This is where people get tripped up. There is a very specific hierarchy of cash flow. Before you started investing aggressively, you need to clean up the balance sheet.
Okay, walk us through the steps. What's priority one?
Priority one is the employer match. If your company offers a 401k match, you contribute up to that limit immediately.
Why is that more important than high interest credit card debt?
because the return on the match is immediate, usually 50 to 100%. There's no credit card in the world charging you 100% interest. It's literally free money.
Got it. Take the free money first. Then what?
Then you attack toxic debt. Credit cards and car loans, get those to zero.
And student loans?
That's the third tier. You have to look at the math. The expected real return on long-term investments, stocks and bonds, is roughly 3% after inflation. If your student loans have an interest rate higher than that, which they usually do, you should prioritize paying them off before investing aggressively.
So only when the debt is zero are you truly saving.
Precisely.
All right, debt is gone. We're saving 15%. Now we have this pile of cash. The document mentions a recipe that a 7-year-old can understand. What is it?
It's called the three-fund strategy. It's elegant in its simplicity. You take your savings and divide them into 3 equal parts.
Just 3.
Just 3. Part 1, a U.S. total stock market index fund. This gives you ownership in the entire domestic economy.
Okay.
Part 2, an international total stock market index fund. This gives you global diversification. And Part 3, a U.S. total bond market index fund.
Bonds. That's the safety net.
Exactly. That's your fixed income and safety component. So you have 33.3% in U.S. stocks, 33.3% in international stocks, and 33.3% in bonds. And you maintain that allocation over time.
That seems almost too boring. No picking winners, no trying to find the next apple.
Boring is good. Boring makes you rich. Excitement is expensive. But to understand why this works, we need to understand a bit of financial theory.
And that is exactly where we are going in part 2. We've laid the foundation. Save 15%, kill your debt, and buy these 3 funds.
Right. But knowing what to buy is the easy part. Sticking to it when the market crashes, that's where the psychology comes in.
We are going to discuss why our brains are hardwired to fail at investing, why stockbrokers might be monsters, and the 15-minute yearly task that makes this whole machine run. Stay tuned. Welcome back to part 2 of our deep dive into wealth building for millennials. In part 1, we established the what: save 15%, pay off debt, and split your money into 3 index funds.
Right. The what is simple. Now we have to deal with the how and the why. Because if you don't understand the mechanics, you will panic when things go wrong.
Chapter 4. Theory. Risk and return. Let's talk theory. The document says investing without understanding theory is like trying to fly a plane without knowing aerodynamics.
It's a great analogy. You don't need an MBA, but you need to know what you own. Specifically, the difference between a stock and a bond.
Break it down for us.
A bond is a loan. You are lending money to a company or government. It's safer because legally, if the company goes bust, lenders get paid first. But because it's safer, the return is limited.
And a stock?
A stock is ownership. You own a piece of the business. You are a residual owner, meaning you only get paid after all the debts and expenses are covered. Because you were taking that risk, the risk of getting nothing, you deserve a higher expected return.
So risk and return are tied together.
Inextricably. If you want high returns, you must endure ferocious losses occasionally. If you want total safety, you must accept low returns. Your job as an investor is to find the right mix of the two.
Speaking of ferocious losses, let's talk about history. I think a lot of us assume that when the economy is good, we should buy stocks, and when the economy is bad, we should run away.
That is the most common mistake. It's actually a paradox. History shows the exact opposite is true. The best returns are made when you buy when the economy is in ruins, when the sky is stormy.
Buy when there's blood in the streets?
Exactly. Look at the Great Depression. Stocks lost 90% of their value. It was terrifying. But the people who bought at that bottom, they made extraordinary gains. Conversely, when the economy is perfect, blue skies, returns are usually lowest because stocks are expensive.
So when my shoeshine boy or my Uber driver starts giving me stock tips,
That's a signal. When everyone is euphoric, from friends to the shoeshine boy, that usually signals a top market. It means there's no one left to buy.
this leads us to what the document calls hurdle number 4, the enemy in the mirror.
Yes, this is the hardest hurdle. Us. Human beings did not evolve to manage long-term financial risk.
We evolved to run away from tigers, right?
Exactly. We are designed to react to immediate threats, the hiss of a snake. In the stock market, a price drop feels like a snake. We panic and sell. That's selling low. When prices go up, we get euphoric and buy. That's buying high. It's pathological behavior.
We're also pattern seekers, aren't we?
We are. We see faces in clouds. And in finance, we see patterns where there is only noise. 95% of market activity is random noise. Yet we convince ourselves we see churns. This is why things like technical analysis, reading charts, is often called a fallacy in this text.
So we can't trust our brains. Can we trust our financial advisor?
This is the controversial part. The text refers to the financial services industry as being populated by monsters.
Monsters? That's harsh.
It is, but here's the logic. A stockbroker does not have a fiduciary duty to you. Their goal is to maximize their firm's profit, not your wealth.
So they're transferring wealth from my pocket to theirs?
Through fees, commissions, and expensive funds. The advice here is stark. Act as if every financial advisor is a hardened criminal.
Is there anyone we can trust?
The text makes one notable exception. Vanguard, founded by Jack Bogle. Because of its unique structure where the funds own the company, they don't have an incentive to gouge you. They align their interests with yours.
So don't trust brokers. What about picking stocks myself or finding a guru who can predict the market?
The text calls this the utility of gurus. In the last 80 years, no one has reliably predicted market crashes.
No one?
No one. And if a fund manager beats the market one year, they usually fail the next. It's luck, not skill. Think of it like a coin toss. If 10,000 people flip a coin, some will get heads 10 times in a row. They aren't skilled coin flippers, they're just statistically lucky.
And I love the tennis analogy here.
Oh, it's brilliant. When you buy or sell a stock, someone is on the other side of that trade. That person is likely a massive institution like Goldman Sachs or a company insider. Trading against them is like trying to play tennis against the Williams sisters. You're going to lose.
Okay, so we stick to our boring 3-fund strategy. But earlier you mentioned there is 15 minutes of work per year. What is that?
It's called rebalancing. Remember, we started with 33% in each fund. Over a year, maybe stocks go up and bonds go down. Now you have 40% stocks and 26% bonds.
So the balance is off.
Right. Once a year, you sell the winner, the one that went up, and buy the loser, the one that went down, to get back to 33% each.
Wait, isn't that buying low and selling high?
Exactly. It forces you, mechanically and without emotion, to sell high and buy low. It removes the psychology from the equation.
That's genius. So to wrap this up, what are the practical steps for a millennial listening right now?
It's a simple path, but not easy. Emergency fund. 6 months of expenses in safe cash. Retirement accounts. Max out that 401k and Roth IRA using low-cost index funds. Education. Read. Read about history and psychology to vaccinate yourself against panic.
And if they do all that?
If they can overcome the spending, the ignorance, and the monsters, they will almost certainly outperform professional investors and retire comfortably. It's a scheme to get rich slowly but surely.
Get rich slowly. I think that's a message we all need to hear. Thank you so much for breaking this down.
My pleasure.
That's it for today's episode. Check the show notes for the full list of steps. See you next time.